I'm Darius McDermott from FundCalibre, and this is the Investing on the Go podcast. Today, I'm delighted to be joined by Jerry Walton, who is the fund manager on the Church House Investment Grade Fixed Income Fund. Jerry, how are you?
Very well, Darius. Thank you. Good afternoon.
Yes, absolutely. So when we do these podcasts, I like to sort of achieve two things. One is to give our listeners a reminder of what the product is and trying to achieve. And secondarily, obviously, to talk a bit about what markets are doing, what's going on, what stocks, what bonds, what sectors. And then maybe if we have time at the end, we'll touch on rates and particularly around UK and inflation. So I know, because I've known you for a number of years now, the distinguishing feature of this fund is a focus on capital preservation and income. How do you go about delivering those two sort of things? And what about the quality bias that you tend to have, which helps in more troubled markets?
This fund was conceived and is run for use within private client portfolios. And that really is key, because we are ultimately a private client firm, and we have our own book of private clients. And this fund is used externally by other private client managers, wealth managers, used within private client portfolios. So we're very aware of who the investor base is, and we think we therefore run the fund correctly and accordingly to achieve the ends of that investor base. And so we've really come at the asset class from a capital preservation, a less volatile perspective, and that's because through our own experiences, we know that when we sit in front of our clients, our private clients, they understand volatility from the equity portion, the end of their portfolio, but they don't understand, they just don't want to experience volatility from the fixed income allocation. So we try very hard to deliver it. And therefore, we are well aware that some people didn't actually invest into this asset class correctly on behalf of their private clients, because they seem to be accepting of too much volatility and don't necessarily have the capital preservation style that we have. So we're not saying other people are doing it necessarily directly, but we think that we're more focused on that aspect of preserving capital and being less volatile. And that manifests itself in how the fund is positioned from a mandate perspective. So we are slightly doing things in a different way to others. We are clearly an investment grade fund, so we're further up the food chain from a quality perspective. And we think that's compatible with the ends we're trying to achieve. So we don't invest in so high yield that we can't. We also have an allocation to AAA, so the best rated paper that we have to maintain within the fund, which is 25%, and that is a minimum. And we seek to deliver a fair yield that's available in the asset class without taking undue risk. And that means we're not trying to buy much sort of lower grade bonds or longer dated bonds that be more volatile, trying to chase yields. As it is, the fund is paying out just shy of 5%, which is a fair yield for the asset class, and a pretty, and that's after fees and everything, but that's a pretty good starting point for any investment within a portfolio. So we really are coming at the asset class, the fund in the asset class, to be a capital preservation offering and to provide a fair yield. But going back to repeat myself, but with less volatility than certainly a lot of our notional peers, but also the kind of volatility that an investor will feel comfortable with.
So another area where risk can come into a portfolio is, and I think you touched on shorter duration on a fund being sort of the average maturity on those loans that you make, obviously times the percentage of the position size, and the longer that duration of that fund, the more sensitivity to interest rates, and the shorter is the opposite. So you said you're positioned a bit short, around sort of 3.5 years. How do you feel about that at the moment? What's the opportunity set in that shorter part of the market? And would you have a bit more duration if, like some, you feel UK inflation and hence rates are going higher?
Well, we're very happy where our duration is. We've managed duration, we think, well over the years and through the different cycles. And it's paramount because there are fairly sort of limited numbers of factors into investment performance within the asset class. One of them is credit selection, one of them is credit quality, but it is also paramount to be positioned correctly on the curve from a risk cycle perspective. And you've only got to go back to recent history going into the end of 2021, early 2022. And most people had too much duration and they've lost a lot of money in 2022. They've managed their duration very badly, or maybe they couldn't position themselves as much as they'd like to, or reposition themselves. We're not a benchmark fund, and this is key, and we're not hugging a benchmark, and that must be the only explanation for why so many people have got their duration calls that had too much duration going into that environment, and therefore lost their investors a lot of money. So that's the charitable explanation of why they didn't do so well. Explanation is that they didn't see an aggressive interest rate cycle coming. And if they didn't, they possibly shouldn't be managing a bond fund. But there we go. Some opinion on that one. And that's what you're saying, are we comfortable when we are? Going back into a more recent history as of last Thursday, when because of the worries that certainly the gilt market and certainly bond investors have with a new prime minister who has apparently lately had a greater conversion to actually being enthralled to the bond markets, but as explicitly stated beforehand that he doesn't give a flying, he doesn't care about the bond markets. Apparently this time he does. Apparently that's not the case. Anyone who actually knows him is that he is not too worried about challenging the selling the gilt market. I think he's completely wrong if he takes that view, and he find just as Charles Carson found out in recent history that you can get some pretty difficult reactions. Anyway, last week when he was coming out with new policies, the gilt market was all over the place, and the 30-year gilt went out to a drop to then reduce the yield of rising to 5.78%. That we haven't seen since May. And in fact, we haven't seen since I was in the gilt market, which was back in 1998, which is quite a long time. And these are dramatic moves. If you try and put these things into context, when you see the kind of yield moves that we have in, say, the 30-year gilt, you're looking at 10% downside. You're losing capital in a dramatic way. If I remaining short at the moment, we're happy because we don't know what these spending plans are going to be. We don't know what the funding plans are going to be. We know that there is unless the economy grows, there's no great source of funding apart from to borrow more money. I mean, you might sort of shift the deck chairs around, the wrong analogy, to say that you're taking money from the international overseas aid development and using it to cut VAT on electricity bills, whatever. It doesn't actually make any difference. You have now a chancellor who resigned explicitly. He was one of the least bad choice, to be fair, Healy. Intriguingly, he was having another chancellor called Healy. There we go. And he resigned explicitly from being defence secretary because there wasn't enough money heading into that area. So he's got potential plans, I'm sure, up his sleeve to try and make that money appear for the defence budget. But the thing is that investors are analysing every single move that they're making, and you can't bamboozle most bond investors. And so if you come out with a new war loan and a new war bond, it's still government borrowing. So it gets sucked into the overall mix. He said he's going to stay to his set of the fiscal rules that they've been sticking to. We'll wait and see. But either way, there's volatility. We saw a lot of volatility last week at the long run of the gilt market. There's probably more to come. So it's a very long way of saying, Darius, that we're happy where we are. We're not about to move our duration at the moment. If we see a dramatic slowdown, and at the moment I was worrying about inflation, but if it doesn't appear, then it's a slowdown in the economy. If we then can see the bank potentially cutting rates, and we'll have a duration. But at the moment, that's not happening.
Well, Jerry, one thing we know when we come to you for a podcast is we're definitely going to get some opinions. So thank you very much for that. I wonder, maybe it is too early to tell, but you've touched on defence. Are there any sectors, not just because of politics, but because of other maybe obvious headwinds, are there any sectors or issuers that you're currently seeing really good value in and Are there any generic areas which you want to avoid?
Well, there's some good quality credits still coming to the market now, with not particularly long dated issues, and they're offering tremendous all-in yields because I know that everyone labors the point that the UK does have the highest government bond yields in the G7, which is where we are. I will point out they moved in pretty much lockstep with other moves in G7 yields, but they are generically higher. We have got, say, our in problems down the long end, I've just outlined. But when we get a decent issue coming to the market, I mean, we bought a recent Heathrow funding bond. This is an 8-year bond, a new issue bond to market, paying 100 basis points of extra yield over government's price paying you about 5.75%. That's a good quality name. It's a very sort of high quality credit. And there are many examples that I could outline along the same lines, but I don't know if it goes too much. We're seeing steady issuance in sterling. You don't need to go out, so to repeat myself, price on the curve to get decent yields. We're in a bit of a sweet spot, we think, if people are looking for exposure to the asset class, because these all-in yields are very powerful. Some people go, okay, you should sort of go further out and buy some longer days issues. Sticking to sterling, and you asked me what I'm going to be avoiding. Very simple answer, because it had a disastrous week last week and it's had a disastrous week this time. Debt is being issued by the hyperscalers, by the big US tech names in sterling, is at the moment something to avoid. I mean, the movements last week in those sectors were very profound, and they lost people a lot of money. So if I go back to February, middle of February, the first movie was from Google, and they issued into sterling. They hadn't issued in sterling before. They issued I think it was a $7.5 billion multi-tranche bonds. Unusually, normally if you're a new issuer to a new currency, you can only issue one bond at a time, and you can establish your whole curve of bonds in that base, your series of bonds. They issued that all at once because they knew there was so much demand. And it produces some interesting investor anomalies because there's huge demand, massively oversubscribed. I think there was 6 different issues here. So there was a 3-year, 5-year, 10-year, 20-year, 30-year. And then lo and behold, they successfully issued a 100-year bond, so a century bond. Now, this is an interesting side of investor behavior because sadly, none of us will be around. You, Darius, or indeed any of our listeners will be around in 100 years. The risk reward of buying a 100-year bond is puzzling, but it was 7 times oversubscribed. They issued $1.25 billion of it, and this goes out in 21, 26, and it was a fairly decent spread at the time. I think it's 1.25% over the gilt benchmark. So it pays a coupon of 6.25%, I think it is. It's down 13% already. It came off 10% almost immediately because the combination of yields going the wrong way and spreads widening out, so that the extra yield pickup you get becoming bigger and bigger because the bond is going down in value. Is a pretty close combination. So you can wait 100 years and get your money back at par at 100 at redemption, but that's quite a long time to correct your initial investment mistake. And these century bonds, I said, they're fascinating because it takes almost a new batch of investors to come along to embrace them, because they obviously haven't seen what's happened in the past. And we've got many different various examples of century bonds that have come out. And there's nothing necessarily wrong with the credit, but it's when they were issued. So the Republic of Austria came out in, when was it? Back in the, I think it's 20, something like that. Anyway, it depends on financial crisis. The bonds and yields were very, very low because central banks cut rates to shore up the system. Did it at 100, it's trading at 28, and it pays you a ground coupon of less than 1%. So it's a totally invested disaster. the Republic of Austria, or even for Google, it's the borrower's dream. You borrow money for 100 years, 6.25%. Not bad. If you're Republic of Austria, you borrow money at 100 years. I think it's 3/8% coupon or something like that. I'll confirm that. It's the investment disaster. So there are two answers to your question. One is you avoid the stuff that is just incompatible with your investors, but also at the moment, Hyperscaler debt is having a very tough time. And this is the last one to issue actually to dollars was last week, was it just week 4, which is Amazon. They issued $25 billion into the market. And that was only oversubscribed by 1.6 times, which is a very low coverage ratio. So you can see that at the moment, these issuers are running into what we call indigestion. So the market isn't necessarily going to take down what they're trying to sell.
No, so maybe we'd be getting an AI bond hyperscaler bubble rather than equity.
Well, that's another conversation. You can say the credit markets are worried about what's the level of what's being issued. But sadly, these companies, which have been asset-light, very profitable companies with enormous free cash flows, turning themselves into companies with enormous liabilities, slowing all their free cash flow. It is on the going cash flow negative, and that's not necessarily a thing.
So I said we would sort of save our sort of view on rates. I know that overlaps with new government and potential policy spending, which as we record today, we're fairly light on detail. But what we do know is there is still some form of conflict in the Middle East. There is still some form of conflict in Russia and Ukraine, both of which have had an impact on energy prices and inflation that's come thereafter. You can't be a bond manager in isolation with having a view. So let's just, rather than going multi-geography, let's just stick to the UK. What's your view on a 12-month view on UK inflation and where maybe next summer we might be on UK rates?
Well, what we've seen this year, because of, as you say, a conflict between US and Iran, is some quite dramatic moves in where rates have been forecast by money markets. So when first after the end of February, when the conflict was unfolding, saw money markets move very dramatically to discount 4 rate hikes by the end of this year, which we felt was a bit excessive. That was as crude spikes and as other commodity complexes spikes. People were obviously rightly very worried about the inflationary effects of that. We then saw, the market is sort of scaling back expectations, and we've seen all these false starts at different, truces and CCRs, and we've got that again. And at the moment, we've seen a bit of a rally today in, certainly we've seen a drop off in crude. We haven't seen a spike go over 100 last week. Because apparently Trump is going to give time for diplomatic resolution to the total chaos that he's created. At the moment, we are seeing a forecast in rates at the moment of possibly just one interest rate hike this year. We have the Bank of England meeting on Thursday this week, and they're likely to stay at a key base of 3.75. Because at the moment, we are seeing with the last inflation numbers we saw did fall back to less than was expected, which is good. But you've got to look at the sort of the implications of crude bouncing around further than just the straightforward price of crude. You've got to look at the spot price, which would be much higher than say the immediate price for what people are paying for crude, rather than further outdated contracts, and that's been much higher than what gets quoted. But also, without getting too technical, you've got to look at things like crack spreads, which is the amount of the difference between the crude price and the derivatives of crude, which is what we all put in the tanks of our cars, and we still haven't. Well, if we haven't gone electric, not trade out of them. And this is what feeds directly through to the consumer. The price of the pump is a function of the crack spread, and that has ballooned. There's no twist about it. It's come back a bit, I'm sure, today. But these are all inflationary pushes. And so that the banking is in a pretty difficult place, as are all the other central banks, but certainly the Federal Reserve and the ECB, because you're seeing potential inflationary pressures. And certainly for us, you're seeing fairly weak growth. We are growing, but we do have inflation still way above our target. And that puts the bank in a bind because they can't cut on the face of inflationary pressures, even if they want to. And they can't necessarily hike in the face of weak growth. So they're in a bind. So the forecast is probably they'll do nothing at this meeting. I'm pretty sure it won't. They'll probably end up doing nothing by the end of the year unless inflation cranks up. To be optimistic, you wanted a 12-year forecast. A forecast for rates are hurting to nothing. I will say it for us. And it's highly likely, sort of near or near about where we are in 12 months' time. You might have seen a 25 beat high, which could be a precautionary measure. But we do have our own set of problems. Across the water, if I can briefly. But actually, if I go to Europe first, TB, they really don't want to have to hike again. They've done a precautionary hike, and they had a hawkish hold last week. They are looking at the gas price very closely because it has risen far more than crude has this time around. But if you look at it in the context of the gas prices that we saw in 22, which was the Ukrainian conflict beginning, the magnitudes of the moves we've seen this time. So they're in a much better place than they were, but it's still, they're very reliant on gas for generation across Europe. It's a major indicator for them to watch. Federal Reserve, they meet we get results on Wednesday. We have a new governor, chairman, who probably wants or has been told to lower rates by his master. His nickname is Sock Puppet. I don't think he's as big a sock puppet as people are making out. There's a 38% chance of them hiking rates this week, but I think it's probably unlikely that they will. They'll probably do anyway. So we're in a very uncertain race environment. The US is better off because they have better levels of growth than others, but they're still subject to the same inflationary pressures as everyone else.
Yeah. So maybe just a very brief then answer just to finish off. Why do you think sterling investment grade is attractive for potential new investors today?
Well, my answer outlined it in terms of our fund.
That's absolutely fine. Yes, you can speak to your fund. That's not a problem.
I have the fund, obviously. And the numbers that matter is that this is all high quality investment grade bonds with a very sort of strong credit policy behind the whole funds. There's no rubbish within there. And the numbers that matter are that across the funds, we have a duration, as you mentioned, of just about 3.5. We're paying out, there's a yield to redemption, and this is with a short life, as you mentioned, around 5.5%. The income yield that's being paid out is 4.9%. And what's also key is that the average price of what we own, because of how rates have moved, we can get it back to what you might term old-fashioned bond investing, where you can buy bonds way below 100, but they're going to be redeemed at 100 in quite short spaces of time. And so the average price of what we own is 97.5. So you can see with a very short life across the whole fund, you've got 2.5 points of upside as well as the yield that the fund is paying out. So that is your return profile. So that's why you invest in sterling bonds. So you don't need to go into a lot of rubbish. You be in the best quality, and that's still the return profile you'll buy.
Jerry, thank you very much. I think that's a lovely, succinct way to end our chat.
This fund focuses on high-quality credits and is not managed to a particular benchmark. The aim is to provide a steady, low-volatility quarterly income stream for investors, and we believe is a strong candidate to make up part of the core of an investor's portfolio. To learn more about the IFSL Church House Investment Grade Fixed Interest Fund, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.